Well, for a detailed look at the fallout from the market chaos, we're joined in the studio by economics correspondent Stephen Long. Stephen, we just heard there from Phil, the banks are one focus. There is a lot behind this volatility, isn't there? I mean, we had relative calm at the start of the week, but I guess nothing's really changed.
In these times, Ali, the markets respond to fear and glimmers of hope. Now, the fear tonight was that some banks were exposed and we would have an announcement from a major bank that they're in some kind of trouble. There was talk that counterparties weren't picking up their phones, that people in banks weren't taking calls from other banks. That caused a lot of panic in the markets.
Any substance to any of that?
We don't know. We just don't know. The recovery came when a key EU official, Olli Rehn, came out and said they're looking at draft legislation and a proposal for a Eurozone-wide bond, which would effectively mean that Germany picked up the cost of the rest of Europe through the bond system, which might be why the German market was down worse than anyone else and didn't recover. Now, that's the immediate. Underlying this, there is a terrible economic situation, and the question really is whether it will merely be very bad or catastrophic. I think a double-dip recession now is the base case scenario that most people are looking at in Europe, because it's basically flatlined on the latest figures. The unemployment rate Eurozone-wide is about 10%. Growth is at a standstill, even in Germany, the supposed powerhouse that everyone is looking to save Europe. And then you have the fiscal austerity measures right through southern Europe, now up into France, which are cutting back on government spending and actually making these economies weaker without actually creating a hope of a recovery, because they can't devalue their currency because they're all stuck in the one currency to restore their international competitiveness. So the economic situation is bad. The question is, does it spill over into bank losses and cause another credit crash?
Well, that bond plan, though, you don't think that that's going to make a difference? Obviously, it sort of turned markets a little.
I think it's a long time coming, and it basically all comes back to Germany. Germany would be standing behind that bond. There has to be the political will in Germany to basically bail out the rest of Europe, and I'm not sure that it's there. And basically, there's just too much debt, and that's the issue. So you've got still this huge runoff of private debt, housing markets weak, the economy weak, in the United States as well. And then you have this sovereign debt crisis, and people are saying, well, there's just not enough money to make it work. Now, Germany might find the political will, but that would trash Germany's economy one way or another, so it's not likely in the short term. The other possible option is the European Central Bank basically pumping out money into the European economy, but that would create a massive inflation problem down the track.
Yeah, so briefly, I guess, as someone said this weekend, has probably said many times before, volatility is the new normal, and let's not be surprised if we do continue to get these big swings.
The only thing that will end the volatility in the short term is if we get a serious crash and it's just all down.
It's a depressing way to finish it, Stephen Long.
Sorry about that, Ali.
Many thanks for joining us.